The impact of inflation on Americans' ability to purchase goods has been felt across the board, from groceries to gasoline to cars. In fact, inflation has reached its highest level in 4 decades, according to the most widely used measure. Inflation will continue to rise as a result of a variety of factors coming together. We must strive to invest in a way that not only keeps up with inflation, but also generates income while it occurs if we want to maintain a solid financial situation. In today's video, we will go over a few investments you can make to build your wealth during a period of rising inflation. We all know the dollar's value is being weakened by a number of issues. One is Russia's invasion of Ukraine, which has fueled fears that the attack may escalate into a NATO-Russia war. Another aspect is the amount of money pumped into the economy by the Federal Reserve's printing machines of the United States during the pandemic. In other words, money is chasing the economy's commodities and services at an excessively rapid rate. This is the broad belief that inflation will continue to rise slowly. That anticipation, though, tends to feed on itself, driving up prices even further. But there are several ways for not only protecting your money from inflation, but also emerging from an inflationary period with more actual wealth. Number 1, hedge of real estate. It's a tangible asset to consider as it tends to rise in an inflationary economy. We all need a place to live, and whether it's apartments, single-family homes, or other sorts of construction, the value of real estate will rise and maintain pace with inflation. Rental properties, which generate an income stream, is one avenue for investors to invest in real estate. Another option is to invest in a real estate investment trust, a REIT. This allows you to invest in a firm that owns and operates income-generating assets. Number 2, gold. Gold has long been the classic investment to protect against inflation. Gold is another tangible asset that tends to keep its value. Whereas financial assets may lose value due to a reduction in purchasing power, gold may not be a perfect inflation hedge, but its price tends to climb with inflation, allowing you to keep your purchasing power. Gold sold for $1,077 an ounce in August 2018. By March of 22, it has risen to more than over $2,000 per ounce. Number 3, commodities. Many forms of commodities are less priced physical assets that perform well during times of inflation. Agriculture commodities, including wheat, corn, soybean, animals, and timber. Industrial metals such as nickel, copper, steel perform well during periods of inflation. The same can be said for natural gas and crude oil, which has increased in price from less than $20 per 42-gallon barrel in April 2020 to more than $100 in March of 2022. Number 4, Treasury inflation protected securities, TIPS. TIPS are government-issued bonds that help protect you against inflation since their principal increases when inflation rises. TIPS also pay interest at a fixed rate twice a year. TIPS coupon payments and principal amounts are updated daily according on CPI changes. The best case scenario is to purchase TIPS before inflation occurs. Then as inflation rises, you can get the full benefit of the principal and interest increases. TIPS purchased too late in the inflationary cycle will already have had a negative influence on your portfolio. TIPS are excellent investments for retirees looking to preserve their principal. And number 5, I-bonds. Series I bonds obtained by the U.S. Treasury. Bonds like TIPS are inflation indexed. The returns on I-bonds are divided into 2 halves. The first is a fixed interest rate, while the second is a component of your overall return that is linked to inflation, specifically CPI. Every 6 months, the interest rate on I-bonds is adjusted for inflation. I-bonds interest accumulates tax deferred, but when you redeem them, you pay tax on the interest at your regular rate. Investing during inflation can preserve portfolio wealth, diversify holdings, and maintain income's buying power, but it can still also increase your exposure to risk, divert you from long-term goals, and overweight your portfolio in some classes. Unfortunately, inflation is here to stay. This means that our salaries will inevitably be able to buy less and less, and there is no quick way out. The only thing we can do is try to safeguard our personal finances as much as we can. Alright guys, thanks so much for watching. If you got any questions, please leave a comment below. Nonetheless, hope you enjoyed it. Please hit that like button for me, and I'll see you in the next video.